Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen & Partners, to our 11th weekly strategy update. As normal, I begin with the latest infection rate for COVID-19. Staggering 5.5 million now infected, 353,000 deaths. Interestingly, those infection numbers, very nearly 50% are now in the Americas, as the surge in numbers in Brazil and much of the rest of Latin America begins to add to the American total. You can see this in the chart, America in dark brown at the top, then in dark green Brazil moving up sharply, Russia and India, a new phase of the infection rate, if you like, to the larger ex-China emerging markets. Continuing decline in Europe, including the UK, and spikes in Asia, but generally very low numbers. We looked last week for the first time at the global Stringency index. Remember, this is a measure of government lockdowns around the world. 0 is the position pre-crisis, 100 is a maximum lockdown. Note the pink line falling sharply, that's Germany opening up quite determinedly now with a rating of 50, so that's only half the full restrictions. US, UK, Spain all falling, but note also the light blue line, a sharp uptick in China as regional lockdowns are enforced to cap some of these local infection rates. That's quite a lesson for us going forward, that the stringency index goes up as well as down. The opening tempo, the better European infection numbers, has contributed to an improvement in the underlying economy. This is obviously the key driver, and a whole range of indicators are substantially better than a week or two ago. I've just snapshotted a few here. The number of containers coming into the Los Angeles Long Beach port, very good indicator of US-Asia trade, bouncing from a low of -30+% to just -6% year on year. The highly respected German IFO Business Climate Index, which looks ahead at the sentiment in German industry, beginning for the first time to bounce off a low. Initial jobless claims in the US, a little better than expected, at lower than the previous weeks, and I could add to that data. Also, some of the deep cyclical indicators are showing they may have touched a low. The Economist Metals Index beginning to rally, and for the first time, gold being outperformed by copper. This gold-copper relationship is quite important. Gold rises when central banks and monetary stimulus dominates. Copper rises when the real economy recovers. That reached an all-time high on my numbers and is just beginning to roll over. We, by the way, took the opportunity to lighten our gold positions just slightly from their very large positions we've accumulated. This has contributed to a continuous upbeat in sentiment for global equities, an extraordinary rally when you adjust in sterling terms, showing the world index coming close back to a break-even position. That'll roll off in gold, I indicated earlier, and gilt yields beginning to flatten out. Volatility coming down nicely, which has enabled us in our target return accounts to reintroduce a component of portfolio protection now that it's affordable. One other big event in the week was the announcement by the European Commission on their next generation EU recovery plan. In a remarkably coordinated performance across governments by Commission President Ursula von der Leyen, they announced €750 billion recovery plan on top of the EU budget and 540 billion of other initiatives, taking the total package to a staggering 2.4 trillion. What hit the headlines was, of course, that 500 billion of that 750 billion is in grants. This is not required in the short term, at least, to be paid back. Now, it'll come with some conditionality. There are lots of hurdles yet to cover. Money won't flow probably until early 2021. But this is a big step towards some outline of fiscal union. It'll be funded mostly by new debt issued by the Commission using its AAA rating. Again, a real breakthrough. As an aside, this will provide Europe with a safe haven bond asset in terms of European Commission paper. A lot of debate expected over the distribution process, size of economy, population, severity of GDP damage from COVID, youth unemployment will all be factors. As to repaying the bonds, ultimately this will be affected by new taxes. Note they're very green in their direction: carbon, plastics, non-recyclables, digital taxes. And van der Leyen referred to it on her website as saying, the European Green Deal is our growth strategy. Now, this is important, one, because it could presage a re-rating of European assets. Certainly, it'll help Italy, Portugal, and Spain and Greece enormously. But secondly, it flows into a real emphasis on climate coming out of this crisis for a number of governments. This takes us to a general feature of what we think will be the post-COVID world. Up till now, of our ESG, environmental, social and governance criteria, we've been focusing a little on the S, suppliers, employees, customers, a cohesive society, as the sharp, unequal downturn because of the crisis rolls across the world. But the E is extremely important, and we think, as Ursula von der Leyen showed, it will be a key part of the recovery packages that countries introduce. It will also be embraced aggressively, I think, by investors. Even before the crisis, a new report from the UK government showed that 74% of those with investable assets over just £25,000 said they're interested in making sustainable investments. And 77% said they would like to tick a box that indicated their investments would be sustainable. In other words, a strong majority of people wanting not to do harm. So what are we focusing on as the stimulus programs from government click into place in the post-COVID world? We think they'll emphasize clean physical infrastructure, renewable assets, storage, grid modernization, recharging points, efficient retrofits to improve the environmental standards of building, education training, natural capital investment, and R&D that's focused on new clean technologies. I would encourage you in this respect to go to our new website and look at the splendid piece from Natasha Randall-Mills on what COVID-19 can teach us about the climate crisis. In summary, governments can act fast, public support is critical, business plays a key role. And yes, I think many of these programs will act today and not tomorrow.